Welcome to Real Estate Accredited every Thursday night at 7 p.m., where we talk the nuts and bolts of real estate investing in commercial real estate. And we're open to discussing residential as well. But our main focus is multifamily real estate. This week, or the past weeks, we've been focusing on an acquisition process, which last week we talked about due diligence. So this week, Philippe, my co-host, will go over the contract negotiation.
All right. Thank you, Jeff. Yeah, thank you everybody for joining us. Welcome to our weekly call, trying to share some insights on in-place commercial multifamily value add in general. And today, as Jeff mentioned, we're still talking about the acquisition process, but more specifically the contract negotiation or the rather contract process. And I'll start today with the high-level timeline that I used quite a bit, going from the deal finding, underwriting, LOI stage that we'll discuss today to the acquisition stage, more pertaining to the contract negotiation that also we'll discuss today. The other typical phases as the hold phase and where you're going to execute your business plan, stabilize the asset, make renovations, etc. Sometimes a refinance and eventually disposition of the asset and shutting down all the entities, etc. So as you can see, the active investor view is much longer, involves more steps than a passive investor view. So again, if we zoom in on the acquisition timeline, at the very beginning, and I'm not showing the LOI negotiation steps, but we'll go over what is part of the LOI. Basically, you're going to spend a good 5 to 10 days to go back and forth on a letter of intent. That's what LOI stands for. And then when it's accepted, then there's another 5 or 10 business days, actually often more, to prepare a contract, or in legal terms, they call that a purchase and sale agreement. So what are the steps? As I mentioned, so first you're going to work on the letter of intent, and the idea there is just to go to the key points of your offer, meaning that you're going to talk about the purchase price, the due diligence period, closing time frame, and earnest money deposits, and any pertinent contingencies. And I'll come back on that topic a little bit later. But that document is not a non-binding document. So it has no legal weight, but that's typically how an LOI is written. Just these very high-level terms that are going to be discussed between the buyer and the seller via a broker, if applicable, or an agent, and just high-level key terms that you're going to discuss. And I would say anything that is important for you at that point, if you're in the position of the person writing the letter of intent, just make sure that you're going to write it down on the LOI. I just put the top level things, but we'll go more in detail in a minute. After, when that document, the letter of intent, the LOI, has been agreed upon and signed by all parties, that's when you start the purchase and sale agreement discussion or negotiation. And basically, that's where you're going to turn your LOI, letter of intent, key points in legal language, right? You're going to also address additional topics to protect you and the buyer. That will be more like at that stage, like attorneys who are talking. Sorry. And typically the first draft is submitted by the seller. And here you have to understand that it is a binding document. So when you sign it, you have to comply with whatever is written in this contract, or you may face legal actions. So that's why you have to hire an attorney at that stage. As usual, if there is any question or anything that is unclear, don't hesitate to either write a comment and Jeff, please monitor the
Yes.
chat if there are any comments. So the LOI, as I mentioned, the key terms, purchase price, obviously number one element that you want to address there. I think a couple of weeks ago, we went through like general steps for underwriting and making some assumptions. So the purchase price is going to be the result of your underwriting and making some assumptions on repairs and renovations, for instance, analyzing the rents, etc. That's what you're going to get. Your purchase price is going to be based on what kind of returns that you want to achieve on a particular deal. And I wrote that there. It's like it's a very common thing. You want to start make an offer that's 5-10% below the number that works for you. Some people do this, some don't. I don't think there's a good and bad way of doing it. It's always better to have a little bit of margin, that's for sure. I don't know if it's 10% necessarily, but if you have a little bit of dry powder to cross the finish line, it's always interesting and it can help the negotiation, especially when basically negotiation, you're going to go back and forth and
It means money.
maybe it's to convince the seller on a particular point that you insist of having in the contract as a buyer. You could always offer a slightly higher price. But for example, next, the due diligence time frame. So typically for sizable properties, let's say 40 plus units, or usually you'd see 21 days. Those would be calendar days. If it's larger properties, which is very often you would see 30 days. This is very classic, but that's your time frame for performing the due diligence. And again, on that, we spoke about due diligence last week, but you're going to perform basically two types of due diligence. One is more paper, meaning that you're going to look at the financial documentation that you've requested to obtain for due diligence, such as trailing 12 months, bank statements, and rent roll, and you're going to make sure that everything is aligned. But there are other, also you want to check the utility bills, utilities, and check the leases and rent rolls, etc. The other side is the physical due diligence. You're going to do the inspection, make sure that everything is in the expected conditions or what the seller would have told you at that point. But yeah, 30 days. And also don't forget, and that will come into play later, at the end of the due diligence, usually you're going to make a go, no-go decision to carry on with the acquisition or just stop right there because you discovered things that wouldn't make sense. It wouldn't make sense for you to carry on with the purchase. Next topic to address the closing time frame. So after the due diligence, you decide to go or no go, and then you would typically, if you're going to do traditional financing, 60 days is a typical time frame total. And usually it's going to be between 10 and 20 days after the loan commitment, meaning that it's going to take about 45 days to obtain a loan commitment. The best is to ask your lender how much time they need. Just apply whatever they're telling you. They will tell you, we can do this, we can do that, and use that number for closing. Always, obviously, purchase price was the expectation of the seller, the higher the better. And for due diligence and closing timeframes, was the expectation of the seller, the shorter the better. I just put as an illustration, it's an LOI we submitted in 2022 on a property in Greenville. It's not just an example. Actually, on this page and the next page, there's going to be the 2 pages of our LOI. I see somebody circled the 60 days. Is there a comment?
It's a bit
Um,
long.
That's typical. Yeah, it is what it is. I
I'm
like to
sorry,
write.
I didn't mean to do that. I was
You
just playing with
you
the
are playing.
annotations
Okay.
I
Yeah,
just
yeah, no
discovered on
worries.
the side.
No
But
worries, Mark.
anyway, sorry.
But yeah, like I like to write my first draft of the LOI, 30 days due diligence, 60 days to close, and then I would include probably an extension, or sometimes I'll leave the extension for the PSA, the contract negotiation.
Would you, and I do have a question on the due diligence. Would you go and ask the apartment dwellers if they like the property, if they would stay, to get their opinion on what they think of the property?
Oh yeah, that's a good,
That would be
absolutely.
perfect.
Yeah, okay.
If you have the opportunity, by all means, yeah, talk to tenants and get their feedback.
Yeah, you may just stand out, rather than knock on the doors, you may just stand out in the courtyard or when they're going to work.
During due diligence, it is recommended to visit every single unit. It's very likely that you're going to meet some tenants.
Yeah.
And you'll see what mood they're in. I guess if they are usually they're not super welcoming because it's an intrusion, but they've been noticed. But some are pleasant people. And I remember having a conversation last year with a tenant of a property here we are looking at in Atlanta. And actually, we were walking around with the maintenance guy, and he was praising this maintenance supervisor. And he was like, yeah, he should get a raise and this and that. He's doing a good job. So it was interesting. But and that gentleman was there for a long time. So yeah, always good to hear some feedback. And I think he had some minor complaints that he wanted to share.
Yeah, I would think I'd just be stealthy and go, hey, I'm thinking about moving in here, talking to the management company. But what would you do?
Yeah.
What would you like to see improvements made to your unit or to the general grounds, or see what they have to say? I don't know. I think
If you get early access, and sometimes it's not every time that the tenants know that the the owner is selling. So there's times like that there's some there, and not every time are the tenants hip to the fact that the seller might be
Right.
selling.
So it would be, and I think it would be confidential on the seller's part that he wouldn't want it announced that he had the property up for sale. So you might have to be a little stealthy or just hang out there on a Saturday to find out. I don't
But
know.
if you requested a walkthrough and it's part of your due diligence, at that point, it's your time. There's no stealth. It's
Right.
Get all the information you possibly can, because at that point you're only hurting yourself. If it's go time. Just collect all the information that you need to make an informed decision.
Okay. All right.
Yep. All right. Yeah, that's the second page of this LOI. I'm not sure how to delete. Let's see, annotate.
Was it there? I did it on my side.
Okay.
Just hit undo. I was
All
thinking
right.
I could take notes on it as you guys are talking, but everybody can see
Yeah,
it.
it's interesting, so we can interact. That's great.
Yeah.
So a little bit. Let's spend a minute on earnest money deposit. So that's basically you're showing to the seller that you're a motivated buyer, and they're going to ask to expect you to show some money. Rule of thumb, you can start with 1% of the purchase price. Sometimes it's plus, it's over that. But what's going to be very important is to define the refundable and non-refundable schedule. So usually you would put some either at the beginning of due diligence or really like when the contract is signed. You may have non-refundable, you may have refundable earnest money. It could be 0.5%, for instance. And then looking at the milestones here, when you complete the due diligence, that money becomes non-refundable, right? And now you're committing to to the closing. Other milestones that you could use, particularly another one, is the loan commitment, but that could arrive much, much later. And it could be 45 days, but it could be, I think, another way to show your commitment to closing. And one thing also is, and actually I should have addressed extensions. If you're doing an extension for closing, for instance, there may be an expectation of additional earnest money deposit at that point. And another thing that is important to know, and that was the case basically in 2021, 2022, it was a seller's market. It was very competitive. And there were a lot of deals where basically to have a competitive advantage, to put non-refundable money day one was the way to go. Now,
Well, how much?
it could be 0.5%, could be 1%.
If it's 1% or earnest or whatever, if they sell to somebody else, do you get all the money back? Would that be written in?
You're committing, you will be committed to buy to them. They cannot sell to somebody else.
Okay, yeah, so they're locking it into you, giving you.
Yeah, of course.
Okay.
No, because again, that would be, that's an interesting question actually. But once you sign, the contract is signed. There would be damages that would be, by the way, written in the contract if they wanted to get out of it.
Yeah, maybe they could sell it for more, but if you offered them 1 million and they sold it for 1.2, you get the 200,000? I don't know.
No.
They
This is
broke the
not-
deal with you, but you made 200,000 for just.
Yeah, that's no,
I'm
but
just saying,
yeah.
I know it's not a perfect world, but it's just a good thought. But anyway,
You would be, I think this was some wholesalers are doing pretty much for fix and flip houses. They're finding like buying or going under contract very low, the low purchase price, and they're selling to fix and flippers, so they're making like so there's a way. If you're the buyer and somebody interested in buying for a higher price, because in the PSA you can reassign. It's going to be written that you can reassign the contract to somebody else. I never heard that on a multifamily though.
all right.
May happen. I've heard that on business jets actually, when I was in that industry.
No. All right.
It's risky business.
Okay, my next point here is to talk about contingencies, and the two main contingencies that you would see in an LOI, because we're still at the LOI stage. It would be financing, especially these days with high interest rates, low loan to value numbers. I think it's important to have something in your LOI that is going to address that you're expecting to secure a loan for a particular percentage interest rate and percentage loan to value. And also, you may put something about how quickly you're expecting that to be completed. But particularly percentage loan to value and interest rate, those are the major criteria, especially. And that was very much true when the Fed was raising rates like every 3 months. So it was pretty important to have a financing contingency, because by the time you start the discussion and you finish, maybe there was more than 0.5% over where you started the discussion. The other one that I highlighted there is the due diligence. And as I mentioned, that's a very, very common one that you want the opportunity to inspect the property and look at every unit and basically decide based on your findings during due diligence just to get out of the deal, because you identify something that you didn't like, additional repairs, for instance, or like the general condition of the building, or additional something may have changed actually on the financing side. If you didn't have financing contingency, or it could be an insurance quote that comes back at a different rate. Very important contingency there that is going to be in the LOI typically. I listed other contingencies that may or may not apply. And I would say appraisal is tied to financing, but it could be. But it's usually those contingencies will be addressed in the purchase and sale agreement in the contract. So how to strengthen your LOI? If you have experience in real estate, we have talk about it. Otherwise, if you are beginning, you can just talk about your general professional biography and achievements that you may have. List all the multifamily properties you own. And if you don't own any, you can list some of your partners. And otherwise, if you own other real estate, single family, for instance, rentals, you may list those as well. You have to show a strong resume. Always offer professional references. It's particularly true in multifamily. In commercial real estate, it's always good to give references like a broker you work with, a lender, etc., etc. And proof of funds. That's something, obviously, if you're going to do a syndication, it's a little bit harder. What you could show is a financial statements of the sponsors, because at the end of the day, the lender is going to ask also that you're going, for people who are going to sign the loan, you need to have a net worth at least equivalent to the loan amount. So I think it's a good idea in that case to show like the personal financial statements of the different general partners on that particular deal. Right now, the purchase and sale agreement, as mentioned earlier, there will be most the critical points. Again, they're going to be the letter of intent, key points that have been translated or converted, rather, in a legal language. So purchase price, due diligence period, closing time frame, earnest money deposit, and contingencies. And there will be additional parameters and contingencies for a bunch of other topics, but title and survey will be addressed. Representations and warranties, always a little bit of, it's very legal, but conditions of closing, like what kind of documents and whatnot. The inspection and repairs expectations, sometimes you may ask, like for units that have not been turned, you have a little bit of a credit back, or occupancy, things of that nature, criteria that have to be met. Closing costs, who is going to pay for what? Default and remedies, again, like more like a legal things, confidentiality, non-disclosure, and dispute resolution. Yeah, those are like more legal terms. Here as an example, first page of a purchase and sale agreement that we started to negotiate last year on the property in Atlanta that I mentioned earlier, actually. And that's when we decided to, during due diligence, we discovered like basically repairs were much, much higher than expected. And so we decided not to pursue. So the process for the purchase and sale agreement, you're going to have lawyers. So lawyers talking to lawyers at that stage, but they're leading the discussions with their respective clients and amongst them. And then the different iterations, it could be, there will be a lot of back and forth, and you're going to redline the agreement. And so they will offer some terms, you will counter and this and that. Actually, I'm addressing some tips next page, but again, when it is signed by all parties, it is binding. So at that point, you have to really deliver, or there might be consequences. And that's why if you have that refundable earnest money deposit that you can get out basically of the deal before the end of due diligence, that's for the buyer, it's a very comfortable situation to be in. Tips and tricks, I don't know if tricks is the right term, but it's more tips. One thing we used last year is to work around the earnest money deposit, actually hard day one, I should have said. So the seller was expecting for us to put hard money day one, meaning like non-refundable money. And the tip, which actually they agreed pretty easily, was to request early access, though in exchange, during the early access, we started to negotiate the PSA. So we had to engage with our lawyer on defining an early access agreement, and then you had to pay our lawyer for negotiating the purchase and sale agreement. The other considerations there, you want to do a collaborative negotiation compared to a competitive negotiation. I think it's different styles, obviously. And I think at the end of the day, it depends a lot on, is it a balanced market? Or is it more on the seller side or the buyer side? And obviously, it would depend on personalities. And I think if one way to look at it, instead of compromising, it's like if you can understand what the concerns of the seller and solve their problem and look at a win for everybody, basically, it's going to be a good experience, right? I think one of the big things is you don't want to rush. It's better to take your time and have an agreement that you're comfortable with and that everybody's comfortable with, and then move forward with that. And that's what I have. Thank you. Any questions, comments? Hopefully it was useful.
Yeah, hopefully that was some useful information from an investor or an investor standpoint. I did drop last week's topic, due diligence, put together a blog. It does also include step-by-step on doing due diligence. Feel free to check that out if you're interested. But yeah, we said before, please do submit if you want a topic of discussion that you're interested in. We welcome those suggestions. If not, we just continue as we go. Yeah, that's pretty much it.
So guys, the next time you do your due diligence, you guys should invite one of us up. We'll fly down, we'll pay for it. And that way we can watch what you do. There is no substitute for seeing it firsthand to see what you're going through. Seriously. It's a consideration.
Sure.
You don't have to decide here.
So you said you'll pay for the due diligence?
No, sir. I said I'd pay for my flight.
Oh, if you're paying for due diligence.
Yeah, nice try, Philippe. Nice try. One of the other things that we could talk about is how LPs get their money in on time. We talked a little bit about it today through a custodian. And seeing that I've lost a deal because my custodian didn't act fast enough, as an LP, that is. That might be something you guys want to talk about if you need money fast, if you have a lot of competitors for that deal.
And when you're custodian, you're referring to a self-directed IRA or something.
That's correct. That's correct. Because at Equity Trust, they have to have their business side approve it to make sure they have all the documents, the OM, company agreement, everything that they need tax-wise. And they sat on it for about 2 days, and I lost a deal.
Really?
I didn't like that too much.
So we also work with a self-directed IRA custodian, but we're in their system. So if an investor is interested in one of the deals, we're already in their system. They already have the RPPM, they already did all that side of the work. So it's just be a matter of the investor doing their side with signing their agreement and things like that. So it'd be interesting to see if maybe you could get in their system as a reviewed business or
They don't always operate the same. I mean,
right.
some of them have different procedures
Mhm.
for directing your money that they have to have done on their end. It's, I guess, their due diligence with themselves before they can write checks out. I pay bills through them all the time, and they're very exacting about what they want. So now that I know, I can do it electronically. But as far as investing, you don't want to lose a deal just because they can't get somebody assigned to review the deal. I mean,
Absolutely, and we let all investors that go through self-directed IRAs that they should plan for a 2 week gap there of going back and
yes.
forth with them and us, and unless you're in their system, that streamlines the process. But usually, it's around 2 week process. Pretty painful process, especially if it's like a different company you never worked with. But yeah, it's just a lot of patience and a lot of communication, I think.
Now, this is Equity Trust Company out
Okay.
of Westlake, Ohio. Heads up.
Yeah, they're big.
I posted a link to our YouTube channel. We started to post the recordings of
That's good.
the past calls. I have a playlist, a link to the playlist as well. If you want to revisit those.
All right, folks. It's the end of today's presentation. We thank you so much for your time. We really appreciate you hanging out with us and continue to try to provide value to you. And you have our contact information. If you have any questions off the topic or on the side, feel free to shoot us an email, and we'll be able to provide anything that you ask or provide any useful information. Again, thank you for your time. Thank you for stopping by.
All right,
Thank you,
thank
guys.
you. Thank you.
Bye,
Bye-bye.
y'all.
Have a good night.
Take care.